Welcome. In this video, is Swftcoin ready to go up? We will analyze this. Don't forget to subscribe, like, and please watch to the end to understand. When we closely examine the chart, we can clearly say that we are facing an inverse head and shoulders pattern that is becoming increasingly evident. This pattern is a significant structure frequently seen in technical analysis literature and is often a signal of strong trend reversals. Especially after a prolonged downtrend, the formation of such a pattern is one of the signs that the market may be preparing to break free from downward pressure and initiate an upward move. At the moment, the price action is in a critical phase of this inverse head and shoulders pattern. To be more specific, the price is currently in the process of forming the right shoulder. The formation of the right shoulder represents a period during which buyers are gradually entering the market and sellers are losing strength. While the right shoulder forms, the price usually creates a higher low compared to the previous bottom, which shows that the market is slowly starting to gain positive momentum. The key area for this pattern to validate is the neckline, which is the horizontal resistance line. Once the right shoulder is complete, the price is expected to rise toward this neckline, where a serious battle will take place. If the price can make a strong close above the neckline, the pattern is confirmed, and a significant upward move is likely to follow. The target measurement after the neckline break is done using a very classic method. The depth of the head is measured and added upward from the breakout point. So the target of this pattern equals the distance from the lowest point of the head to the neckline. In the current chart structure, the proportions between the head and shoulders appear quite balanced. This is a strong sign that the pattern may work effectively, because in some cases, if one of the shoulders is too long or too short, the reliability of the pattern can decrease. But here, the balanced structure increases the likelihood of a successful breakout. It should also be noted that necklines in inverse head and shoulders patterns don't always break on the first attempt. Especially during periods of low volatility or when there isn't enough volume support, the price may rise to the neckline and get rejected, leading to a short-term pullback. However, such pullbacks are generally interpreted as minor resting phases before a stronger move. If the neckline is broken on the second or third attempt with more force, the following rise can be much sharper and quicker. Another important detail is volume behavior. In inverse head and shoulders patterns, an increase in volume during the breakout is a very positive sign. If a noticeable rise in volume is observed when the price breaks the neckline, this indicates that the breakout is not a false move and that buyers are truly stepping in with strength. Therefore, it's important to closely watch volume charts, not just price movements. As the pattern starts to play out, in terms of potential targets, an upward move equal to the head depth from the neckline can be expected. However, this target is usually taken as a first objective. If such patterns form on higher time frames, the price may not only reach this minimum target, but also begin a new bullish trend, moving toward much higher price levels. On the other hand, we should not ignore the possibility that the inverse head and shoulders pattern may fail. If the expected buying pressure does not appear during the formation of the right shoulder, or if the price breaks above the neckline but then quickly falls back below it, the pattern is considered invalid. In such cases, a proper risk management plan must be in place. For example, if entering a position at the neckline breakout, stop loss levels should be placed just below the neckline. This way, in case the pattern fails, the loss is kept to a minimum. Additionally, in some cases, after breaking the neckline, the price may perform a pullback movement known as a retest. That is, it returns to the broken neckline, finds support there, and then begins the actual upward move. If such a retest occurs, it indicates that the pattern is likely to work more reliably. But we shouldn't rely on patterns alone. We also need to consider other metrics. Stay tuned. When we evaluate the current price movements within the framework of Elliott wave theory, we observe that the second wave has largely been completed, and the transition to the beginning phase of the third wave is underway. According to the theory, the second wave is generally corrective in nature and gives back a portion of the gains made during the first wave. During this phase, many investors experience uncertainty. While some believe the market will continue to decline, those who analyze more carefully recognize it as a preparatory stage. The transition to the third wave is considered one of the most critical and exciting stages in Elliott theory. This is because the third wave is typically the strongest, longest, and most aggressive price movement. At this stage, prices gain significant momentum, often surpassing investors' expectations. If the analysis is correct, the third wave should reach at least the 1,618 Fibonacci extension level. This level is calculated based on the distance between the low of the second wave and the high of the first wave, and is used to estimate how far the current movement might go. However, when market conditions and investor sentiment are strongly positive, the third wave often doesn't stop at just the 1,618 level. If momentum strengthens further, it is common for the price to reach up to the 272 Fibonacci extension level. These levels, especially when tested with volume support, provide important insights into the strength of the ongoing trend. If the price maintains a healthy structure while progressing toward these targets, interim corrections tend to be brief and shallow, another typical characteristic of the third wave. During the third wave, investor psychology also undergoes significant changes. The initial hesitation and doubt are replaced by hope and enthusiasm. This optimism causes prices to climb step by step, and technical analysts pay close attention to potential interim resistance and support levels during this period. Even within the third wave, the market experiences minor pullbacks, but these corrections are not large enough to disrupt the main uptrend. Elliott wave theory. Practitioners often aim to take maximum advantage of the strength of the trend when trading during the third wave. Volatility increases during the third wave, and short-term pullbacks can occur. However, it's important to remember that the overall trend remains upward. Even these small pullbacks can present additional buying opportunities if managed correctly. Also, due to the nature of the third wave, the news flow in the market typically shifts to a more positive tone. Media coverage supporting the uptrend increases, new investors begin entering the market, and this further contributes to the price rise. Therefore, during the third wave, a move beyond the 1,618 level and toward the 2,272 level signals that the market is moving in alignment both technically and psychologically. Looking at volume analysis in particular, it should be clearly evident that volume during the third wave is higher compared to previous waves. Increasing volume confirms that the price movement is healthy and strong. If volume is decreasing or remains flat, there's a risk that the third wave may not reach the expected strength. However, under normal conditions, meaningful increases in both daily and weekly volume are expected during the third wave. According to Elliott theory, the third wave is the phase during which investors experience fear of missing out. As prices rise rapidly, previously hesitant or cautious investors begin to rush into the market, which further accelerates the price increase. So, the third wave is not just a technical formation, but also a reflection of collective investor psychology. In conclusion, at this point, where the second wave has ended and the third wave has begun, the price is expected to move toward at least the 1,618 Fibonacci level. If the market gains strong momentum as expected and volume support continues, testing the 272 level also becomes a high probability. Accurate technical analysis and disciplined trading strategies at this stage will offer investors the chance to maximize their gains from this major price movement. However, as always, it is essential not to compromise on risk management principles, because no matter how strong the third wave may appear, the market always has the potential to surprise. Therefore, closely monitoring both technical data and macroeconomic developments will increase the chances of success. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.